So hello everyone, thank you for attending. More people are coming in, but we can definitely start with a discerning few. Everybody knows that since January 15th, the landscape of liquidity doesn't look the same, and this respected panel will both chart the current map and help us navigate through it. I leave you in the trusted hands of Alex Necritin, CEO of Nextstreams. Alex could explain about his background and how it relates to the topic in focus. Thank you very much and enjoy the roundtable.
Hello, my name is Alex Necritin. I'm the CEO of Nextstream, and I'll tell you a little bit about my company because I'll tell it in a way, and that's really the reason why I'm moderating this panel. So my company, primary function of it is we help brokers, high-frequency traders, and I see a lot of you guys in the room, and regular traders find LPs for their business, for their type of flow. So that's one function. We're essentially a liquidity consultant. It's easier than to search, call up 40 different providers individually, cut a deal. We can make that process easy by finding their needs. Additionally, what I do is I do some high-frequency trading of my own. So with those two functions, Jonathan and the team at Magnets thought that I would be a perfect person to do this because I'm actually going to be asking these guys questions as if I'm asking for myself. So when I'll be getting answers, I'll push back with my own, for example, especially on the high-frequency trading stuff because I want to know the LPs to do it at. And that's basically it about me, and I'll introduce the guys. Maybe one by one you guys could say a little bit about yourselves.
Sure. My name is Hormoz. I'm the global head of institutional FX for Divisa Capital. Divisa Capital was created in 2009 and got an FCA license in 2014. And we recently announced a round of funding of $100 million from Middle Eastern investors. And that has put us now in the last 5-6 months into a huge growth mode in a space that we find is kind of changing rapidly, and there's a huge need for well-capitalized liquidity providers.
Hi, good afternoon. I'm Rami Solomon. I am the CEO of Stata Global Markets. We are a FCA-regulated prime of prime liquidity provider, FX and CFDs. I used to work for Integral and Citi and IG, so I've been a long time in this space. The opportunity arose to set up a prime brokerage, and as with Hormoz, I feel there's a great opportunity there to service customers in a changing landscape. I believe that having a last mover advantage gives us the ability to dynamically service customers.
Hi, good afternoon. My name is Ian Daniels. I run the EFX sales for EMEA at NatWest Markets. Hopefully you all know NatWest Markets, part of the RBS group. We're one of the top tier 1 global banks. Our focus on Western Europe and the US and it's part of the APAC region. I've been in the industry, and might not look like it, but for nearly 20 years, various roles from back to front office. So I think I've seen a few things in my time. My team is responsible for the delivery of our electronic franchise to corporates and financial institutions across the EMEA region.
Great. So I think let's start off. We came up with about 5 or 6 questions that I think are pretty pertinent to what you guys want to know and what guys like me want to know, and we'll just dive in, ask one question after another, and discuss them. For the sake, I think, of this type of expo and this group, when we'll talk about liquidity providers, we're going to primarily focus on broker liquidity providers like these two guys here. Essentially, they'll be taking margin from other brokers and acting as an LP. And then Ian is kind of the one step above them because he's somebody that's providing liquidity to them. So that's kind of the structure for you guys to understand it. So these guys are broker LPs, and someone like Ian is a tier 1 LP who's providing liquidity to them. So he'll give a different point of view. So let's start with the first question, and the first question I think is pretty, I don't want to say basic, but it's on my mind, it's been on my mind a bit, is there's a lot of competition growing. So there's a lot of brokers popping up, and the offering is, at least the way I see it, is pretty similar. Tight spreads, you know, you get in your, as they call raw spreads, which is like 0.3-ish, and a commission. And, you know, the commission is relatively the same across the board. You know, it depends if the broker LP uses a PB and what connectivity provider they had, like in the last panel. But it's relatively that kind of, let's say, $10 to $15 commission and a 0.3 spread, right? And they connect via these connectivity providers like 10 Prime XM. So it's very similar among all these broker LPs. So how can an LP differentiate themselves? What's different? What can make an LP essentially unique? And what can make an LP competitive? What can make an LP attractive to guys like you that are looking for a liquidity provider?
Yeah, so, you know, if you're looking for a liquidity provider, clearly there is hundreds of things to look at. There is locations, what type of liquidity provider, geographical, the server locations, the kind of pricing that a liquidity provider prices you in, the symbols, the server locations, the capitalization of the liquidity provider. There's so many things. And it's becoming a competitive market where I think everyone expected there to be more liquidity providers and surprised that there's less of them. And that's because of the regulation that's happening. I think over the last, sort of, if we look back at 20 years ago, there was a lot of small traders at tier 2, tier 3 banks that were kind of shock absorbers for big events, and they could provide liquidity in the market. That's all gone now. So it's all down to the tier 1 liquidity providers that us as tier 2 have to access. And to access that, you need, you know, quite a lot of money. You need you know, $50, $100 million to be able to do it properly. To access, you know, what RBS is providing here, and they don't want small clients. So it's becoming an interesting market. I think it's changing rapidly, and we're there to fill that gap for our clients.
So you're kind of saying that the tier 1, your LPs, could make you competitive from, say, another tier 2 liquidity provider like
I think the burden is becoming more and more on the tier 1 LPs.
So let me ask you this question. So like, how, when you're trying to get tier 1 LPs, who sets that up for you? Your prime broker? Is there or you have to basically make that relationship
we
individually?
have to make that. Yeah, I have to know Ian very well. I have to have, you know, drinks with him every now and then.
Every now and then.
I have to know him. So that's how it works. So all the top LPs, top banks, and you know the names, the Goldman Sachs and the JP Morgans, HSBCs, we have to know them very well, and we have big teams to manage that liquidity. It's not an easy thing to do, and they have a lot of requirements on us. They expect us to be extremely professional, and you know, a lot of things. They check us. You know, they come into our offices quite often to check things, and there's a lot going on between LPs and us.
Is it something like is it one of those things? The more tier 1 LPs you have, the better, or is it just quality? Or you know,
well, I think a while ago people had that thought that you know just get as many. There aren't actually that many tier 1s anymore out there who sort of hold and internalise and take risk, but. It was a case of, let's get 15, 20 LPs, but actually that doesn't work. I mean, for me, the sweet spot's about 8 to 10, because if you're aggregating, you're not getting any better service. You're maintaining relationships. The 8th, the 9th, 10th, you know, maybe 12th, 13th liquidity providers getting a very small amount of business from you. It's a nothing relationship, and actually what you're getting out of it is pretty much useless. So I think it's a case of having, like Hormuz says, strong relationships with, you know, dependent on what you need. And you may have 15, but you may only, if you do have 15, then you may say, I only want currency for certain currency pairs to certain LPs and things like that. But, you know, a good 8 to 10 seems to me pretty good, and then you get quality.
Let me ask you this. So if I'm a broker coming in to say to these guys, am I allowed to say, hey, what exactly are your LPs? Should these guys be doing as part of their due diligence, finding out exactly who's providing liquidity to them? Or is that information confidential? Or how does that work?
It's up to these guys, really. I mean, I don't think it depends. Certain relationships we have, they know that. Others they don't. It's kind of up to.
I've seen in the past, like some didn't want to share, and some.
Yeah. I mean, sometimes it's on their website, for example, and people ask us, can we put your name on our website? But other times it's not. It's kind of up to these guys.
I think if I can add in here, it's quite interesting. Ultimately, for me, what's changed is access to liquidity. That's the issue here, which has become difficult and is becoming more difficult. Access to top quality disclosed liquidity. That's where I think people have had a problem. In the past, I think people have been able to access top tier institutional liquidity, and post SNB. The credit intermediation steps have made that very, very difficult. So, for example, Citi, if I think about when I was there, we had a lot of broker customers on our books on the PB side. We used to do credit intermediation and give the ability for them to face the street to consume liquidity from Ian and many other banks. Post that, it became very, very difficult because the banks and I think the top tier credit intermediaries had underpriced risks, didn't really understand what was going on in the broker space and the retail space, and sort of had an offboarding fest where ultimately they did not want to face people who had these kind of business models. So this is the opportunity for firms like us to maintain that relationship. I think if you have that direct relationship, it's not a number of, as Ian says, it's not aggregating 20 feeds. It's having 5 quality relationships and being able to say, hey, I know that guy at this bank, I have a direct stream from him, and having quality technology that allows you to distribute, aggregate, and give that to the customer in the way that they want.
So it became harder after the S&B for tier 2 guys like yourselves to get hooked up with guys like Ian.
Exactly.
And you needed more capital for sure to do that. And that's what a lot of us are going through and getting more capital, those who can.
And this is something I've been thinking about too, and what I advise to my clients is like certain tier 2 players or certain broker LPs, let's say that, they don't have a PB. They're aggregating themselves, they're netting themselves. And I was saying if your LP has a prime broker and can access guys like Ian, I think that adds a little stability. Sometimes if they have a prime broker, it may get a little bit more expensive because there's that prime broker cost, but that cost might be worth it because even from a safety of funds perspective, guys like broker clients with broker LPs would be putting up money into coverage account. Prime brokers do due diligence on their tier 2 clients, and that due diligence, if they can get a prime brokerage account, that should give you some level of safety. It should make you sleep better at night to have a prime brokerage account. So when you guys are doing your due diligence on your LP, that should be a question. That would be a question I would ask is, do you have a prime broker? Who is your prime broker?
Yeah, I'd also add that it's interesting you should ask what kind of business model that your prime broker or prime of prime broker is taking. We have what's called a match principal license. I believe you have it too. So this means that we cannot take principal risk. If you're a broker and you face us, you open an account with us, you take our liquidity stream, that is back to back with the street, that's back to back with the market. There's no sort of, I'm taking a view on this client or that client or anything else. The trades are getting passed straight away via the technology to a liquidity provider. And that's extremely important in terms of, risk counterparts. That's the kind of thing. Things happen, and post SMB, it shows that it doesn't matter how well capitalized a company is, firms like FXCM had problems, firms like Alpari had problems, and it can happen to the most sensible companies, but if you have a de-risked business model that allows you to be match principal, there's sort of no conflict with the trading that you're doing. You just have to make sure that you have good liquidity to execute against. So it's a consideration that broker customers like yourselves that hold customer funds, it's going to be part of your due diligence as part of MiFID II in terms of having a counterparty assessment, and knowing the business model of your liquidity provider is actually part of that due diligence that you should be doing on us.
This is actually, I think, a great way to segue into the second question that we want to discuss. And this one is very near and dear to me because a lot of my revenue comes from high-frequency trading. So going in line with this, and maybe Ian, you could give me a new perspective on this as well. Does having does having better quality tier 1 LPs help high-frequency traders? And let me make sure all of you guys are clear on what high-frequency traders are. So essentially, there's going to be traders which are retail traders. These guys are losing, and those guys are pretty easy to deal with, and everybody will take them with a smile on their face. And, you may want to internalize that flow, manage the risk yourselves. You may want to STP it, but that's not where your problem areas are going to be. Problem areas is where you're going to have guys, a few of them are sitting in this room that I see, and guys like me coming in, opening an account, and you're going to start losing money. And your LPs are going to start losing money on me because I'm going to be making money. So what do guys like Divisa and Stater need to have from their LPs to help them handle guys like me, and how does that go? And go ahead, but I'm very curious to hear what you got to say about that too.
I mean, high-frequency traders and aggressive traders are quite interesting because it's a slightly different thing as well. High-frequency isn't necessarily aggressive. But let's say we take a high-frequency trader like yourself, and you happen to be a little bit aggressive as well. Alex, you are, I know you are.
A lot aggressive, yeah.
And let's say you're trading 2 billion a day, you're high frequency, and we as a liquidity provider, we should be able to handle, especially as an A book, as in we don't take risk, we pass it on. We should be able to handle your trading, no matter how aggressive you are. And I mean, so if you're doing 2 yards a day or 1 or 2 yards a day, and you tell me, look, I'm trading, and I said, look, I can't handle this, then the question I have to ask is, you're doing 2 yards a day, somebody's handling it. If I can't, there's something I'm doing wrong. That means that I can't handle this. You're doing your 2 yards a day with someone.
Right.
And you're doing it day in, day out. And if I say, no, I can't handle any of this, then there's something wrong with my technology. So I should be able to find someone to match and your liquidity scenario.
And that's the point. I think, the advantage that we have is that we have access to direct liquidity. The problem that you may get or encounter when you undertake your high-frequency trading is that if you're dealing potentially on an aggregated price of an aggregated price of an aggregated price, you're going to be hitting the same LP 3 times, hence no one likes it. So, ultimately, if you can face a liquidity provider that has a few core relationships with good banks or non-banks, ultimately there's a lot of good non-banks that have come into the mold recently. You have good technology that can distribute that in a low latency environment. You've got good technology providers that can help you do the analysis. Part of our job is liquidity management, and part of that is analyzing fill ratios, the round trip execution times, all of the things that you're going to complain to me about that I need to think about in terms of why am I having a conversation with this LP because he's winning everything, or why am I not having a conversation with this one because he's not winning anything. So there's a few things that we can do. If you set yourself up correctly with the right technology, the right infrastructure, and the right relationships, then flow like yourself is not actually an issue. High-frequency trading should be encouraged, and ultimately, because there's no conflict of interest, we're not here. If you win, we win. You trade more, we get more spread or commissions. So it's actually, it's good for all of us.
I think from a bank LP perspective, it kind of depends what you mean by high-frequency trading, what kind of way you're trading, what manner, how you're getting into positions and out of positions, etc. We at the end have some, I think we have some of the best analysis tools on the street. So what we may see from these guys, we'll get to a tag which will show us what it'll be, ABC1, ABC2, whatever. It doesn't really matter because it doesn't matter who the client is, it's a tag. And then we can analyse the market on that and decide from there, we can see if it's immediately against us in a millisecond, then we know it's trying to arb the latency or whatever, and we can decide whether we want to price that or not. And then we may have, there's often a price for everyone. There may be like an exhaust feed which it goes on, which is just, you take us out of risk when we want to be taken out, and then sometimes that works for us. But I do feel there is generally an appropriate price for everybody. But again, what we don't like, another bank might do, because everyone's risk management is different. So that's where these guys come in terms of aggregating the right people with the right currency pairs, with the right breadth of offering, to give the end client that choice.
Ian, so you guys have like algos that are basically your systems that are handling this liquidity. It's also HFT market making algos. That's your primary.
Kind of, yeah. I wouldn't call it. We wouldn't call it HFT because that's a word we don't use. But yeah, ultimately, our electronic market making business is looking at things that are coming in, how we're exiting that risk. We have various risk management tools that will hedge at a certain point. We try to internalise a significant proportion of the flow we see. We see a lot, obviously being a UK bank, we see a lot of cable, euro sterling flow, euro dollar, etc. And ultimately, we've got a big focus on corporate, so a lot of the time you may be matching off against Joe Bloggs and co from Manchester or something like that, and this, and that's the thing that, like I say, there's a price for everybody.
It's an important thing actually in terms of the franchises that the large banks have. Give a very, very good indication of their ability to sort of be professional market makers. At the end of the day, there are 3 or 4 large institutional FX franchises out there. The top 4 people in Euromoney. Those are the guys who are able to take serious risk on both sides of the book and make prices all day in decent sizes and provide a serious amount of liquidity to the market. And beneath that it becomes more difficult. Post SNB, the issue that we've had, and you've seen it in sort of spikes in volatility, flash crashes, one example. There's less liquidity out there because there's less people pricing because the things are EFX sort of franchises, and the risk tolerances have been reduced at the bank level. So you are seeing more sharp moves in liquidity because there's less participation from some of the large banks that are in there.
Let me ask you this. I know Ian mentioned tagging, right? And so each client has a tag, and just for you guys, what that means is, that the LP doesn't see your clients by name, but they see a tag. So they'll see if a client is winning. They'll see like tag ABC 1, 2, 3 is making, that's his trading profile, and they'll adjust accordingly. Some places where I trade, they have no, tagging is not everywhere, but if a place is doing a lot of volume, if a broker is doing a lot of volume, they've actually seen me trade. They've called me up, hey, as long as you do less than X, you're going to be fine because you're going to blend in with the rest of that flow. Is that a thing? Are you guys okay with that? Like let's say Divisa is sending you 20 yards a day. If out of that 20 yards a day, half a yard is winning, are you guys more likely to kind of just overlook it? Half a yard is trading like high frequency. Are you guys more likely to overlook it? Is that a thing? So, and as it relates to these guys, maybe selecting an LP, look at the flow that they're doing, and then can your tough flow blend in with that flow?
I guess it depends. There needs to be a certain amount of volume for it to be relevant. But then, it could be, we tend to look at things on the longer term horizon in terms of, we're not looking at 1, 2 trades, but we're looking at a longer term horizon. But if that guy is doing a relatively small amount but costing a lot of money, then that's significant. But, they could be doing a large amount and being okay, just a little bit and losing us a little bit of money, that might be less significant. So it kind of does depend on the cost to us. But, generally, we've worked well with people like these guys in terms of getting the right fit for the right client. And again, like I said, I'll sort of keep going back. If they have the right liquidity providers, then they can have a mix which will suit most people. So in some shape or form.
Yeah. No, I mean it's partly the relationship that you have with your liquidity providers is going to dictate the quality of liquidity you can offer out.
Go ahead.
I think at the end of the day, they do look at P&L, RBS. So, NatWest, Royal Bank of Scotland, they look at the P&L of the account. So
of someone like you.
Yeah.
Yeah.
And whether the tags that you mentioned, whether some of the tags are not good, that's up for discussion. But if the overall P&L is okay, that's
okay.
that's why you have to be small.
So the so maybe the moral of the story for you guys is when you're looking for an LP, try to find out the amount of flow that they're doing, right? Find out what level of flow the LP is doing themselves, and maybe the bigger that is, the more likely your aggressive clients are to blend in, because you're going to get those clients that are going to upset your LP. It's inevitable. It's going to come. So that's something to think about. Can I bring up the topic of last look? Is that a...
Yeah? What do you want to know about it?
Is that something that these guys should pay attention to, or what
Yeah,
how
I
does it
guess,
handle
yeah,
that?
last look is just quickly to go through because we don't have so much time,
Sure.
but last look is when the liquidity provider you would send an order, and during that 200 milliseconds, the liquidity provider decides, I don't want to take this trade because it looks like I'm going to lose. Or they take it and they don't, they have the option to say yes or no. Some regulators, some people believe that's kind of on the borderline illegal, but it's something that's happening in the market, and it's kind of a function that's giving liquidity in the market. So it's a very difficult subject. Regulators are all over it. Actually, it would be interesting to know Royal Bank of Scotland what they think about it. Because
so from our position, I think there's various things at play there in the public domain. We currently, we believe in last look and apply it symmetrically. There are others who may apply it asymmetrically. So, if the price has moved a certain amount in either our direction or your direction, then we would reject that trade. So, and we are symmetrical in our round trip time. So we won't hold on to the trade longer and then decide whether we want it or not. There's an outward and an inward time between trade acceptance that's symmetrical for us. So, whatever you may think, realistically, without last look, spreads would be wider. So that's part of it. So it's kind of up, it depends. You paid your money, you take your choice. There are no last look venues out there, which are doing okay, doing well. And then if you want to go there, then that's obviously up to you. But, the market itself still has a last look.
Yeah, I think that's a good point. I mean, ultimately, when you're making your consideration as a taker of liquidity and you're interacting with a broker like ourselves, you need to see how high up that shopping list that is. Why do you need last look? Is it because the strategy that you're doing is something that maybe is taking advantage of what's happening in the market in terms of latency or some other strategy that you may want? Or is it the fact that maybe the underlying liquidity providers that are providing you with that liquidity are not strong enough to take your strategy? So, there is a choice, there is last look. The key point that Ian says is that without last look, spreads would be much wider. People are prepared to make a market, and banks have massive franchises take risk all day to make prices for the benefit of the community for their business, and they do it at a price. If there is firm liquidity that's being offered, then guess what? You're not going to have the same depth that you would in last look. You're not going to have a non-last look feed that's going to be good in say 5 million. That just doesn't happen at a very tight price. So you have to work out what kind of strategy you want. You have to work out what kind of liquidity you need to fit your business model or your customer base and optimize it accordingly. There are venues that offer non-last look liquidity. There are LPs that will offer you a non-last look feed. So, as long as you have access to a mix of choices, you can match your customer with the appropriate liquidity profile.
Yeah, maybe I could add to that too. I mean, we've had success with some no last look venues, their own trading, and we've had success with some last look venues. But one thing, if it's a no last look and it's firm, and if you have a trader, for example, that's really sending in bad flow, that could cause a problem right away, and there's not much to do about it. But if this trader is sending bad flow and there is a last look scenario, maybe you could figure out, you could work. That's another big thing, is the ability to work with your LP together. Say, hey, we're getting this trader. What do we do about him? You know, maybe we can work out some kind of a last look scenario there.
But it's a function of the access that your broker has availability to. You know, if a guy can only access a small number of liquidity providers, you know, that will dictate the amount of liquidity that he can offer to his underlying customers and the choices that he can do, and the technology that he works with as well. These are the key things that you need to take into account.
Key factors. Yeah, maybe let's use this to transition to the next question, which kind of goes, you know, a lot of brokers like you guys, you're going to want to probably warehouse some of the risk yourself. I don't know, and then some of the risk you want to send out. Sometimes you want to send out everything and get, instead of just an STP deal. So in STPs, you make money on the commissions and the markup. And there's also such a thing as a rev share deal. And a rev share deal is where you get a percentage of client losses. So you don't manage your own risk, you don't manage your own book, but you'll send out your client trades. Say your clients lose $1 million in a month, you get back, I'm just going to throw out a random number, say 30% of that. So you'll get $300,000. You don't have to manage your book in-house. So, you know, I kind of almost at one point, I saw rev share deals disappear. Like, well, not disappear, but there's way less of them, and now they're coming back all of a sudden. I don't know what you guys can say. I know both of you are STP, but what are your thoughts on rev share? And what are your thoughts, you know, actually, how to decide what risk to warehouse, what trades to send out?
So, like you said, we don't B-book, we don't take risk on clients' flow, so therefore we can't share a revenue that we don't make. So, I think clients have to be a little bit careful with profit-sharing deals, because if you're sending your flow to a broker that is giving you a share and is risking, because of that, risking something, there's a chance that they might blow up. And that risk is something you're taking that risk with them. So a lot of people think, well, I'm doing a rev share deal, therefore I'm not taking any risk, I'm just taking the upside. That's not true. Someone who's taking risk, a broker that's B-booking, is riskier. It's as simple as that. And they do occasionally disappear. So if you're an A-book, we don't take risks. So if you're an A-book, you don't do profit sharing. So again, I think RBS would.
So that's one big moral of the story. And I actually totally, sorry if I jump in here real quick, but that's one big moral of the story that I see a lot. The firms that do offer rev share, and there's some decent ones. I'm not saying anything bad about everyone, but there's more firms that are not as stable as, say, these guys that are offering rev share. So there's some decent ones, but it's less of them. There's the firms that are offering STP. If you give me 10 firms that are offering STP and 10 firms that are offering rev share, I would trust to put my money at an account with the STP, with more of the STP ones. I think it's pretty safe to say that, you know?
Yeah, I mean, I would say, look, there's a couple of things I guess I want to say. Brokers, and not us in terms of liquidity brokers, but brokers have a right to, if you are appropriately regulated, you can make markets, you can risk take, that's your prerogative. I think the issue that has happened in the past is that people have maybe not had adequate capitalization to manage that risk, and they've not had maybe adequate expertise to manage that risk. So the kind of thing that I'm seeing that's evolving is that people are trying with regulation to effectively de-risk their businesses, and that includes sort of taking more STP business, but also looking for maybe people to manage the risk for them now. And clearly we can't do that kind of stuff, but these are the things that I think is sort of the next evolution in that kind of, in that space where risk managers, you know, the big banks are ultimately risk managers. There are hedge funds that do risk management. These people are interested in interacting with this community to do that kind of stuff. So, you know, there's nothing wrong with brokers wanting to make profit and revenue stream from, you know, making markets, taking risk. That's if you've got the capital and you've got the permissions, you can do that. There's not an issue. I think the issue is making sure that it's done in a credible way that doesn't affect the integrity of your business and affect your end customers who are retail. So.
Yeah, not major amount to add. I just add to the fact that I think revenue share is not something that we're involved in and won't be. But I think that the key point is like, as well as the upside risk, obviously there's the downside risk and you know, going on about SMB and things like that. But history has taught us that actually if something's too good to be true, it often is not true. So I think that, you know, you need to be aware of the downside risks and just pay attention to those as well.
Yeah, there's something you guys want to look at too, and I know Hermos mentioned this, is you're basically, if you're getting revenue, you're also liable for the loss. They have like symmetrical and asymmetrical revenue shares deals. If you're getting a symmetrical, that means you're definitely going to, like, if your clients win, you're going to have to send in money. You're going to get a higher percentage on those deals, for sure. So those are going to be more, you know, everybody wants 50-50, but those are going to be closer to 50-50. You really want an asymmetrical. You want where if your clients win, you don't have to send in money, it carries over against your future wins. Against your future wins, your clients' future losses. So, and those are going to be smaller. Those are going to get down into like, you know, I'm not quoting these numbers, but down into like the 20s percentage-wise. Those are more realistic. But they're also, the firm is going to want, a legitimate firm is going to want to really do diligence on you. They're going to want you to put money up in a coverage account. So those are definitely things to pay attention to. And I think with revenue share deals, safety of funds is a big thing. Make sure the firm you're dealing with is stable. Do your due diligence there. I think maybe let's use this to jump on. This is actually a perfect. Perfect to jump on to the next topic, which is talk about crisis events and force majeure. Is that how you pronounce it? And the S&B. And I mean, I've seen firms that did revenue share deals break down, and I've seen firms that did STP deals get into a lot of trouble. So let's talk about that real quick, and not real quick, but jump into it.
Yeah, I mean, big events like the S&B, this is where the market moves very quickly. There's a big gap in the market of 200-300 pips. I think that's always going to cause a problem. I don't think they'll go away. There is no way around it. You can innovate. You can help yourself with different things like reducing margin and managing flow, etc. But at the end of the day, when something like that happens, that there is a problem. If there is a big gap in the market and the pricing wasn't available, then there is an issue. And that stuff will happen again and again, especially now that, like I mentioned, there is less genuine liquidity providers and risk takers, and there is a lot of those smaller shock-absorbing traders that were there 10 years ago are not there right now. So the shocks come straight through, and there's less, shock absorbers that can dampen that earthquake. So right now, I think this could happen again where there's big gaps in the market and there's problems, but we're trying to manage that. If we can pre-plan it, then we'll do that. If we can't, then we still have things in place to try and mitigate the risk.
And I think that's the key point in terms of risk mitigation. I think from our perspective, post-SMB, it's we work very hard to tighten up all controls and ensure that the appropriate controls are in place, risk committees, all sorts of things. But actually, it was well worth it, as it proved in the sterling flash crash when it dropped 6% in a matter of minutes to a 30-year low. We were okay at that point. So actually, these type of things, again, learning from the past to help you in the future. But again, these things will happen again. So it's about having the right controls in place. There's been South African rand, New Zealand dollar, various little blips, relatively big blips there. But obviously the sterling one was bigger. But I think it's about control.
Yeah, no, I agree with that. I think having seen these sort of these experiences and big moves, I think being at Citi when the SMB happened and seeing the impact it had on Citi from a price making perspective, being one of the largest prime brokers on the street, prime broking most of the larger firms, and then even our FX margin business that we used to run at Citi, it affected us quite heavily. And hindsight's a great thing, but things, there are simple things that you can do in terms of managing the risk of your business, in terms of managing the risk of your underlying customers. Concentration risk is something that can be looked at. Pegged currencies is something that, it's now a no-brainer in terms of margining appropriately. Regulators have done their thing in terms of trying to de-risk the retail industry in terms of not being able to have 500 to 1 positions on pegged currencies and so on, limiting leverage across the industry. All these things are sort of positive things that you think about, why didn't we do these things before? And sometimes it takes an event like that to happen. What Holmer's alluded to is also right. We've been operating in effectively flash crash and S&P accepted. We've been operating in a low volatility environment. It's been not much interest rate differential. There hasn't been a high volatility period that the retail industry has had to endure. So, moving into that space, and with the lack of sort of liquidity providers that are out there, the shock absorbers that Holmes is referring to, and the reduction in the risk appetite of some of the banks, means that you will get more gaps, you will get more movements, you will have more events like this. So it's critical from us, sort of managing up to our prime brokers and our liquidity providers, and also managing down to our brokers, clients, and their underlying clients as well. Just a practice of sort of appropriate risk management, appropriate leverage, appropriateness in the clients, and onboarding them in the first place. There's a few things that just practices that were undertaken by good phrase from Mark yesterday, as on a panel, bad actors in the space. There are a lot of good participants in the field, and if they can de-risk their business models as such, they should be okay.
I know we're coming close to the end here. We have time to get into more questions, or should we just leave it?
Do we have any questions from the crowd? It's quite rare pool of knowledge and experience. So, okay, that's good. Just a minute.
Say you have this, I would say, whether you consider a high-frequency trader or whichever, who has been winning a lot, and Tier 2 may not take action, but Tier 1, I don't know whether do you have, like, after a certain length of time where this traders has been doing a lot of damage to you, and you create another group to trade against them, especially with algo.
Well, I guess taking the first bit, I mean, I think in terms of winning, losing, and things like that, actually, we monitor flow in a certain way, and actually sometimes when we go back to these guys and say we don't like that guy, this guy's really good, they may be surprised because actually it's someone who's losing all the time, but we don't like it because of the way they get into positions and things like that, and that might not suit our risk management. So, it's quite hard to answer your question directly because actually we're not seeing all the end client's business. I think it's actually, and we've had this quite a few times. There are people out there who, the end client who all the liquidity providers don't like. But again, there'll be most people will be suit somewhere. But yeah, for us, there's been times when we're told this guy loses money all the time, and how can you not make money? But we can't. It's just the way we manage risk, and other people manage it differently.
I think if you're trading with a liquidity provider that is very simple and booking and looking at the P&L and says, I'm losing here, I have to do something, then that's the end of that story. But if it's an advanced scenario like we've discussed, their algo might see your flow as something quite interesting. They might join in, they might offset it, they might be able to handle it in a way that's not that simple. So they might have flow that's opposite. So it's not so easy to say that you have a P&L positive flow, therefore it's not going to be good. We might be able to handle it very well.
Yeah, it's certainly not zero-sum game. It's, if you have a panel of liquidity providers, we have a lot of clients that trade with us, and clearly they're algo traders, and the entry is against one LP, the exit's against another LP. Neither LP are disappointed with the flow that they're getting because ultimately they've managed their books in an according way, and we have a dialogue to make sure that if they don't like it, then there's something that we can do to solve that, different liquidity, speaking with the end customer and so on. So, it's a lot of algos have been successful in effectively trading on artificial prices. And the more that you interact with people like ourselves and people like Ian, and you're starting to interact with the real world and real liquidity, then sometimes those algos and those trading strategies will fall into problems, because ultimately that liquidity is not available at that spread and that price and that frequency all the time, because that's not what it's like in the real world. So, once you take that into effect and you take that into understanding, some algos just will have a ceiling in terms of their performance. There's a point at which they cannot grow, because at that point they have to interact with the real world. At the point they interact with the real world, they start to get rejections, they start to get poor performance and slippage and so on, because it's just not an algo that's built for interaction with the real world. So that's the reality of the situation sometimes. I'm not saying your algo is that, by the way.
Yeah, I think we're going to wrap it up. I know we're getting kind of tight on time. We'll stick around if we have any questions specifically to us. I think that's basically it.
Yeah, thank you very much.
Thank you.
I'll share an anecdote with you. Preparing the panels, obviously I was in touch with emails with all of the speakers of all of the sessions, and this is by far the friendliest one, where the emails were responded as quickly as possible. They met for the longest time, and I think it was reflected here. So thank you, all of you, for this upbeat, in-depth discussion. We will take a few minutes break, and then we'll go to a keynote speech about keywords in FX. Did I say it right? Close enough. Okay, thank you very much.